What is going on, world? We are going to be talking about today the difference between impulse and correction in the markets. We're actually going to break down the difference, how to identify it, how to read these charts, because in the beginning, nobody knows how to read these charts correctly. And if you understand impulse and correction, you are going to be already ahead of everybody else, probably 80% of the people who trade in the market. So, you know, for the most part, we are going to go ahead and get started on identifying impulse and correction. I'm actually on the euro dollar chart. You can pull this up on TradingView. If you haven't seen the other video about how to set up your TradingView, go ahead and check that out first. But today we're going to break down how to actually read the markets in a way that will identify how to enter and exit trades efficiently based off of pure price action, no indicators, nothing else, pure naked charts with only trend lines and a few adjustments here and there. So let's go ahead and break this down. Euro dollar, we can go ahead and go probably to the daily chart, and we can just kind of just start to come in here and try to identify some impulse. So what does impulse look like? Well, impulse, first of all, will always be big bodied candles that are pretty decently sized, that show direction, right? So obviously, we can identify this section of candles there. We could also identify a few other different impulses, all in the selling direction. Here are a couple more impulses. So we're just going to go through here and we're going to identify all these impulses. So this is the daily chart. For every single candle you see represents a day and time, and you'll see these patterns and these impulses on all time frames. Impulsive candles are basically just showing a massive amount of one-way direction, selling or buying. So in this instance, we're looking at selling within a period of days. So these four periods of impulse are always going to be followed by what's called corrections. So we're going to go ahead and try to find all the corrections. So basically, what a correction is a period of time where price generally ranges. It doesn't really range. It doesn't always have to range up and down. It can range off to the side, diagonally. But the biggest and most important part, we have to understand where are the impulses and where are the corrections. Because generally, when you I can identify where the impulses are coming from, and the direction they're going, you can probably predict where price is going to go, combined with a lot of different factors such as candle continuations, patterns, being a certain A plus, B plus sell or buy zones. We'll talk about that in the future. But the first step is being able to identify impulses and direction corrections. So we'll just continue to mark up as many of these corrections as we can find, and then I'll go into a lower time frame and show you it's basically going to look the same. I'll clear everything up. So the impulse down for 4 days, and we corrected for a few weeks or so. And then we have another impulsive phase down, and then we correct, another impulsive phase down, and then we correct for about a week, and then we move down for a few days, and then we correct for a few days. So that's basically just identifying that. And then, it doesn't always have to move down in that direction. It can also move up. So if we go to a different area of this chart on euro dollar, we can see obviously impulse, and then we can see correction. So what these actual impulse and corrections are called bull flags and bear flags, and I'll get to that in another video. But for just now, we're going to be talking about or just learning how to separate the corrections from the impulses. So obviously, you won't always be in a correction on a daily time frame. You could go in within those daily time frames to lower time frames and then find more individual impulses and corrections. So basically patterns within patterns, and then you'll basically be able to trade that within a smaller time frame. But overall, if you're trading a higher time frame, you're going to be looking at this stuff on a more longer period of time. So that's the benefit. You get to choose whether you want to be somebody who holds trades for months or holds trades for minutes. So again, we have impulse and correction in this direction. You can see we bought for approximately a few days, maybe a week or so, eight or days. 8 or 9 days, you can just kind of count how many candles are in these phases, these impulsive phases. Basically the easiest way to identify is just pure big candles, right? So these big body volume candles are going to be what you're looking for. And then correctiveness, is going to be very small movements that are ranging, and price is going to typically be in the same range of price for a long amount of time, but depending on what time frame you're on. So let's actually go to a lower time frame and try to see if we can do the same thing. So we can go on the 1 hour chart, and I'll just go to anywhere randomly in price, and then let's see if we can find a really good example of this. So in here is really good. We have impulses, and then we have corrections. So you can see how they're just smaller in time frames. Over time, the price ranges for a little bit, and then it finally moves down. And then I'll wrap all this up with a bow and explain to you what it looks like on a higher time frame, which looks a lot more like what we looked at earlier. So again, impulse correction, continuation, impulse correction, continuation, right? That's in a bearish cycle. We could go to maybe here's a really clean one. These are called bear flags, and we'll get to that in another video, but just impulse correction, continuation. This is what you have to understand so you can be able to identify the direction of the market. The market is going to send you messages. You have to be able to read these messages so you can do these trades appropriately and with the most possibility in your favor. So you can see these impulsive candles. Let me see if I can find a really good example of that. Give me just 1 second. So like I was saying, basically you can have these bull flags and bear flags. Here's some impulse correction and another continuation. Um, but mostly you're looking at all this stuff pretty bearishly through all these times. Um, Again, we have more flags or impulse correction continuation. So if you want, you could just basically go through all these different pairs and just be able to identify all these impulse corrections and continuations. It's a really good practice, and I highly suggest that you do it so you can identify flags and identify how to trade as well. And we'll talk about that in the future. But for now, impulse correction continuation. It's really simple. It's kind of repetitive. I know I sound like a broken record, but it was burned into my mind from my mentor. So we're going to go ahead and burn it into yours as well. So again, impulse, correction, continuation. If you can understand that, then you can understand 80% of what people really don't understand. So this is basically phases. We're looking at direction. If we can identify direction, then we can identify how we can trade. So that's it for now for impulse and correction. Hope you guys learned how to identify those different phases. We're going to go ahead and move on to the next video and talk about how to actually identify patterns within these continuation patterns, which are flags, which are impulse and continuations. No, it sounds difficult, but we'll all wrap it up in these next videos you guys are going to see.